Hello, everyone, and welcome. This is Jason with Top Shelf Traders. Thank you for joining. It is towards the end of the day here, 4:30 Eastern, give or take a minute or two. Welcome, everyone. We've still got folks filtering into the room, so thank you for joining. I'm thrilled to be joined by Janet Flanders Johnston from TrimTabs, and we'll get to her introduction in just a moment here. But as folks are filtering into the room, if you could just please give me a yes and yes, let me know that you can hear me okay and that you can see Janet's screen okay. Just a quick yes and yes. All right. Perfect. Perfect. Thank you. All right. This is part of our ongoing education series for our 350,000 plus investors and traders. For those of you that are joining and wondering if we are in fact recording this, of course we are. We'll go ahead and post this to our channel. If for whatever reason you have to duck out early, no problem at all. We'll make sure that a copy of the recording is sent to you. So as mentioned, we are thrilled to be joined by Janet Flanders Johnston. And the topic that we're going to be looking at today is a little bit different than what we've historically looked at, or even the content that we've historically watched and looked at Top Shelf Traders. We have a lot of investors across our universe. Folks that are looking at optimizing their portfolio, figuring out how to get more out of their portfolio, or even construct a stronger, higher performing portfolio. And when we survey our universe, one of the questions that we consistently get is, hey, can you share more information about the ingredients that make up a solid investment portfolio? No, so not so much just about trading and getting in and out of the market, but a long-lasting, or as TrimTabs calls it, an all-weather portfolio. And so when we met Janet and her colleague Alan, we were thrilled to have them on. We reached out to them. We asked them if they would be willing to join us and present at one of our events. We were thrilled when they said yes. And so here we are. Today's topic is going to be about how to enhance portfolio returns. And there's going to be specifically one ingredient that we're looking at that TrimTabs specializes in. So in a sea of balance sheets, income statements, analyst reports, all sorts of information about publicly traded companies, it's very easy to get lost. But there's a very specific ingredient that we are going to encourage you to look for, and we're going to talk about today. It's called free cash flow, and using that as a way to get superior returns. So we'll turn it over to Janet in just a second here. As always, we like to keep this informal. So if you have questions, I'll be manning the questions box. I see a couple that have come through already. We'll save those to the end. And if you have any difficulty whatsoever, for technical reasons, just put a comment in the questions box and we'll get you taken care of. So with that in mind, Janet, thank you for joining. It's great to have you. You were mentioning at the outset you are a Georgia Bulldog alum, so I won't hold that against you as a Golden Gopher, but I will say this, there are no banners hanging in our rafters other than hockey banners, and nobody north of, well, at least Iowa really cares about that. So all kidding aside, welcome. Thank you for joining us.
Thanks, Jason. I appreciate you inviting us to share our story and our thoughts about the market and how to enhance portfolio returns. So today, my goals for the webinar, I'm going to give a brief introduction of TrimTabs Asset Management and our next generation ETF products, where we combined our active management with our quantitative multi-factor methodology. I'm going to talk about why free cash flow is the key to quality portfolios and how it helps us deliver excess returns, along with some additional layers like strong balance sheets, share count reduction. I'll also discuss alpha smart alpha, smart beta. What's the difference? How we execute on our active alpha delivering strategy. And in the end, I'll give a brief macro overview and some of our top stock recommendations and our favorite country. So TrimTabs, we were founded by Charles Biederman. He started a firm called TrimTabs Research in the early 90s. And many of you may know Charles. He's a regular on CNBC with Rick Santelli. Charles was very focused on supply and demand factors such as mutual fund money flows, corporate stock repurchases, the impact of secondary stock offerings on stock prices. In 2011, Charles sold the fund. He's still a large shareholder, but he's not involved in the day-to-day operations. Our Chief Investment Officer is Ted Theodore. This is the third time that I've worked with Ted, and the first time we worked together, we were on an investment committee chaired by legendary investor Marty Zweig. Ted was an early adopter of ETFs. He was also a senior portfolio manager at Citibank and Morgan Stanley. And he was head of equity strategy at Citibank when he authored the first published paper on growth versus value. I consider myself a veteran technology and growth stock analyst. I have also worked as a portfolio manager for a private U.S. equity partnership. And at TrimTabs, I'm responsible for the day-to-day management of our two ETFs. So our firm was started in 2011, and in 2011 we launched the first actively managed multi-factor ETF. And we manage a family of ETFs and separately managed accounts, and our focus is on free cash flow, strong balance sheets, and share count reduction. We're owned by a private equity. We're a private equity investment for a wealthy family office in New York that has a very long time horizon. So why is free cash flow the key? Now, we're trying to create all-weather, high-quality portfolios that tend to outperform in up and down markets. And we believe that free cash flow is sort of paramount in identifying quality companies. And the only reason we think to start a business is to grow cash. I mean, ultimately, it's not to create earnings per share growth or revenue growth. It's to create free cash flow after all the expenses. And we believe that free cash flow is a better measure of profitability because there's a lot of discretion in reported earnings and balance sheets. And in 2016, the Financial Analyst Journal, they published an article, and it was called The Misrepresentation of Earnings. And the research was a result of a survey of 400 CFOs. And the findings are pretty sobering. Fully 20% of earnings reports were felt by the respondents to be intentionally distorted, and by a significant amount, 10%. So we think that free cash flow is just a better, cleaner measure of corporate profitability. So some of the challenges that come with this corporate financial reporting is that many of the elements that go into earnings per share and in the balance sheet accounting are discretionary. With revenue accounting, it's primarily a timing issue, and because you have recognized revenue, it doesn't always coincide with when the company is paid. With expenses, there are many instances where management has to decide if they're going to expense an item or if they're going to capitalize. That decision has different impacts on what the earnings look like at the end of the day. And then increasingly, intangibles are a growing item on balance sheets, and they can be hard to value. Trademarks, client list, goodwill, which is the amount of money that's paid for a company over the value, the perceived value of a company when it's sold. So all of these items can cloud the bottom line. And so we use free cash flow just to get to a cleaner picture of organic growth and what's going on within a company. So what are the benchmarks of a strong company? We look for companies that are growing their free cash flow. We look for more transparency. We don't like companies that have a lot of accounting gimmicks. We focus on superior balance sheet entries. We also look at share count reduction because we want to make sure that companies aren't engineering their earnings per share growth. And as investors, if we're owning the same or a little bit bigger piece of the investment pie, we like that. As you can see from this chart, the more years that a company has consecutive free cash flow growth, the larger their outperformance relative to the S&P 500 tends to be. And the more years that a company has negative years of free cash flow growth, the larger the underperformance of their S&P relative to major market indices such as the S&P 500 tends to be. So what we do is we combined disciplined, seasoned, active management with our quantitative models. The first step that we do is we look at free cash flow growth. That is our primary, our most important factor. But we combine that factor with strong and improving balance sheets. What that gives us is a high quality factor. The quality factor is the least volatile of the other traditional factors, whether it's size, cap, volatility, beta, market capitalization. Quality seems to be less volatile. And that high quality factor we look to in terms of creating our all-weather high quality portfolios. Then the next thing we do is combine our strong and improving balance sheets with share count reduction. And we want to make sure that our companies are growing organically and not engineering growth so that they look better than they actually look. One of the things that we've seen quite a bit of over for many years now is that companies will borrow money, interest rates are low, they'll buy back their stock, and that makes their earnings per share growth look better than it actually is. So what is alpha? So to generate alpha, you have to be active. If a product is passive, by definition, it can't generate alpha because a passive product can only generate the return of their benchmark. Alpha is associated with excess returns over a major market index, and it's also risk adjusted. And for instance, in our portfolios, we have a market beta of 1. And so we don't use leverage to generate our alpha. And when we think of smart alpha, we're combining active management with our next generation multi-factor models, and we're implementing our investment philosophy in a disciplined and modern manner. So for us to consider something smart alpha, how we look at it, we think of it as multi-factor, all weather. You know, our goal is to outperform in up and down markets, high quality, a disciplined process, active with true discretion. That doesn't mean more turnover. And also doing it without leverage or concentrated positions. Now, a smart beta has been the trendy product in the ETF world. And I just want to pose a question. Is smart beta really smart? These products, what they do is they use an alternative weighting to the traditional market capitalization weighted major market indices. These weightings can be based on size, value, growth, volatility, beta. They're generally based on a single factor. If that factor isn't working, then the smart beta product will underperform the market. And I'd like to give everyone an example or something, to think about. For example, we can all agree, I think, based on academic research, that value outperforms over the long term. That's been well established over and over. But if a factor is out of favor, it can outperform in the short to intermediate term. So if you look at this chart, you can see that value has underperformed relative to the S&P 500 since June of 2013. So with these, quote, smart beta products, what we believe is that the investor has to be smart, and they have to know when to use, they need to know what factor is working and when to use these products, which inherently aren't the smart ones. So in terms of our stock selection process, what we do is we take the 1,500 most actively traded Russell 3000 stocks. Then we calculate the average changes in free cash flow, balance sheet ratios, and share count. And we rank all of those stocks relative to each other. And then when we go to construct our portfolios, the highest ranking stocks are candidates for inclusion, and the lowest ranking stocks are candidates to be sold. As active managers, we pay close attention to things that our models cannot anticipate. We manage the sector weightings. We manage tax consequences. Last year we were up over 26%, but we did not deliver a capital gain to our investors. We, especially things that models can't pick up, for instance, disruptive technologies. Amazon is changing the landscape of the retail sector. Many retail companies screen well on free cash flow, and so for us, we dig a little deeper in the retail area. We're not particularly overweight that sector, and we try to make sure that we have the companies that are going to be winners in the long run. We also look at political risk. We sold Facebook, screens well on free cash flow. We sold it earlier in the year. We think it's possible that they're going to be more regulated and their business model will change. In the end, we have 100 stocks. They're approximately equally weighted. We tend to trade every month or so, 5 to 8 names. And the characteristics that we like, we're buy and hold. Our portfolios tend to be all weather, high quality, and our goal is to outperform the Russell 3000, the major indices in both up and down markets. We think we're a great core equity ETF, and we're also an alternative to core equity, not only core equity exposure, but passive buyback ETFs. And we have been consistently delivering 200 to 300 basis points of alpha over the Russell 3000 since we've been managing money since 2011, when we started managing money with this strategy. Oh, do you have any questions? Should we pause?
We've got a couple questions coming in. Thank you, Janet. There's one here that just has to do with clarifying how you were able to deliver an overall return with capital gains. Is that something you're able to go into more detail now, or is that something you'd like to revisit at the end?
To clarify how we've been generating alpha, well, the capital gains question. Yes, yeah. I can clarify that. Yeah, our turnover, I think last year was about
60%.
Was about 60%. We tend to, we tend to sell our losers, and we'll and pair them with new buys. And also, when we're selling something that we've lost money in, we'll trim something that has done well. For instance, NVIDIA is a company that we have owned for a long time. It's one of our favorite stocks. We've trimmed it several times, but we tend to trim it when we're selling something that we have a loss in.
Got it. Okay, fair enough.
And we can't guarantee, we're not tax optimized. We cannot guarantee that we will not deliver a capital gain, but we're very tax aware.
Got it. Another question, you mentioned that retail stocks will sometimes screen well for free cash flow, but you dig a little bit deeper. What are some of the, and if you've already covered this, apologies, what are some of the things that you use to weed out retailers that screen well for free cash flow, but otherwise don't meet your criteria? What makes the cut and what doesn't make the cut, even if someone has good free cash flow?
I think the companies that are going to survive the Amazon effect are companies that have very strong market position, companies that are executing and delivering on with their own online strategy.
Got it.
I think those are probably the two key, and free cash companies that we see continuing to have free cash flow growth, earnings growth in the environment, but mainly market share positioning and a plan and executing on their own.
Okay, fair enough. We have another question here. Valen, I'm hoping you can clarify it. You're referencing Janet and Alan, this isn't directed towards you, but one of our viewers here that's asking about how to handle the large drawdown. So Valen, if you could please clarify what you're referencing so we can ask a specific question of Janet, that would be great. And Janet, I'll continue to eye the questions. This is great so far. So we'll let you keep going, and I'll continue to collect more questions.
Okay, so was there a clarification of that question?
It hasn't come through just yet. It came through as how to handle the large drawdown. It was the only question we weren't able to get to in this round, and I'm just asking the viewer to clarify that.
Okay.
So once that comes through, I'll pass it along.
So we continue to see strong trends driving the U.S. and global bull markets. One of the major benefits for the U.S. market is tax reform. It's been stunning to hear company conference calls and the amount of free cash flow growth that is going to immediately fall to the bottom line is pretty stunning. And it's not a one-time event, it's continuous. We believe, I mean, earnings starts this Friday with large banks reporting, but we believe that U.S. S&P 500 earnings are going to surge in the first quarter. Free cash flow growth is going to surge. We're looking for companies to announce significant increases in share repurchases. We're looking for dividends to be up strongly year over year. And we think that this U.S. growth is being driven by strong earnings, tax cuts, record corporate cash, and a strong business confidence. In addition, we're seeing synchronized global growth as a major driver also in the U.S. and globally. Most countries have positive leading economic indicators. Global inventories are low. Consumer confidence is high and rising globally. We're looking at different anecdotal evidence. China's One Belt, One Road, they're going to spend $1 trillion on infrastructure. So we're seeing a lot of positive trends in Asia. What are the risks to this continuation? Obviously, a faltering of synchronized global growth, trade or currency wars. At this point in time, there's been a lot of talk, but we think we're in this environment where there's no war yet, there's no peace. We're certainly monitoring it closely, but at this point, it's okay. We'd be concerned about surprisingly strong inflation. Inflation has been moving up, but not sharply, certainly not surprisingly. And while growth is putting upward pressure on inflation, inflation is being held back by technology, competition, globalization. So this is one of my favorite heat maps. So we track we get the latest data. I think this is February. And these are it's a composite of leading indicators for each country. And what you can see, the US and Canada got a little bit greener this month. Some places got a little bit, China slowed down a little bit. What you can see, Europe, generally speaking, is positive. The UK, which is, going through this expensive divorce called Brexit, is probably the weak point on that side of the pond. But generally speaking, the numbers have been good in terms of economic indicators globally. What you can see here is consumer confidence globally has been rising, and here are some examples. The blue is the U.S., which bottomed out in 2016. China has been really strong, which bottomed out first in 2016, and Japan also bottomed out around the same time. So for some of our top stock picks, Sam Adams, which is America's largest craft brewer, they're benefiting not only from tax reform, but there was a last-minute rider that was written into the tax reform bill that's benefiting craft brewers. Their core growth is strong, but also their non-beer trends are very hot. In March, they captured 62% of the cider market. They have a product called Trusted Tea, which is growing 30% year over year. So Sam Adams is one of our favorite companies. NVIDIA is a corporation that we've owned for a long time. It continues to be one of our favorite stocks. They're a leader in the 3D graphics processors and related software. Their business is growing over 100% year over year in the cloud data center area. They're a leader in computer gaming processors, artificial intelligence, robotics, the automation of cars. I mean, they're one of the drivers. They're at the top of the food chain in terms of processors for next generation technologies. Another top pick of ours is Match.com. They own the highly popular online dating sites Tinder, and OkCupid, in addition to Match. They're, a market share leader. By far, they own the largest market share of the online dating market. Tinder has over 3 million subscribers, and since last fall when they announced their Tinder Gold app, they are successfully monetizing those subscribers. And they're also now getting some advertising revenue on the Tinder platform. So we think they have a great plan to monetize these properties, and Match continues to be a top pick of ours. Another one is Zoetis, and Zoetis is the only publicly traded pure play in pet or companion animals in terms of diagnostics and medicines, also for livestock, horses, poultry production. We like this healthcare play because they're not regulated from a pricing standpoint. In some ways, their play on synchronized global growth in terms of the poultry and the livestock production as more as we've got the synchronized global growth and people are eating higher protein diets, and they're also play on people spending more money on their pets. Our favorite country is Japan. We think they're successfully emerging from their lost decade, their 25-year deflationary period. Before the last decades, Japan was the second largest developed economy. Their consumer confidence is improving. Their leading economic indicators are improving. Women are going to work, and women who have never worked are going to work in droves to fill the unemployment gap. Their companies have restructured. Their manufacturing margins are improving. They're a leader in industrial automation. That's part of the reason their manufacturing margins are improving. But they also make a lot of the products used in industrial automation. Their tax receipts and their employment are approaching the record highs of the early 90s. And some of our favorite companies, Shiseido is the largest cosmetics manufacturer in Japan. Supposedly, they have this new product that not only smooths out wrinkles but rejuvenates skin so that it looks younger, has a younger texture. We'll be watching that closely to see how it works. Fast retailing is, they just reported great numbers, great free cash flow growth for their quarter. They're growing very fast in China and the US. They're leading fast retailer. They're very innovative use in terms of their technology, fabric technology in their fashion. For instance, this winter they had these thin leggings that were made of this fabric that basically would hold in heat and keep you a lot warmer than traditional leggings, but that's just one example. And another favorite global company is Indibor, and they've been fast-tracked for a monthly shot of Suboxone, and Suboxone is thought to be one of the most promising drugs to reduce mortality with the opioid epidemic. So, and you can see from this chart, the very top line that's our performance. For our composite, our annualized return is 20.43% since we have been running money under this strategy since 2011. Our excess return has been 394 basis points. Last year, we were up around 26.5%. The strategy is available as an ETF. Our flagship fund is TTAC. The ticker symbol is TTAC. And then we recently, last summer, launched an international version of this strategy. The ETF symbol is TTAI. And as of March 31st, we are top 1% for 6 and 12-month returns from by Morningstar in the large cap blend category. And we believe this high quality all-weather strategy using TTAC, our publicly traded ETF, is a great core equity product or substitute for passive equity buyback or dumb beta ETFs. And if you dig a little deeper into TTAC, it's a blend of growth and value companies with exposure to all capitalization waves. Any questions?
All right. Thank you, Janet. A few questions coming through right now. One question from before, when you're experiencing a loss, how do you handle the drawdown? So do you hedge or do you take the loss, and how does that affect the total performance longer term?
We have 100 positions in our portfolio. We tend to, we really don't have large drawdowns. If we have a company that blows up, it's a 1% position, so that's 20 basis points.
Okay. The other question that came through had to do with Brexit and the fact that the divorce seems to be messy and there doesn't seem to be much resolution in sight. Is there a horizon, a time horizon that you're thinking that Europe will get back to normal, or is that just completely on the sidelines for you at this point?
Well, the trends we've seen in Europe have been very strong. Europe has been participating in synchronized global growth. But it has been weaker in the UK. And we're watching the negotiations closely. If the UK decides to vote again, that would be a positive development to help them move forward in their negotiations and how things are going to work between the UK and the European Union.
Got it. Okay. Of the 100 positions that you have, is there anywhere where someone can go and see, is there any place someone can go and see the mix of industries or sectors that you're in and how they're weighted?
Absolutely. One of the things we like about the ETF wrapper is that it's fully transparent. And if you go to our website, TrimTabs, TrimTabsFunds.com, you can see our holdings are posted every day. I think our sector weights, or on our fact sheet, you can get our sector weights. All of that information is available.
Okay, great. So of the sectors that are out there, what would you consider to be the most overhyped and overvalued, but lacking any substance or any real substance from a free cash flow standpoint?
Overhyped and
Overvalued.
It's interesting. We really don't see this market as overhyped. It's the bull market that everyone hates to love. And we just don't see that. We continue to, we're believers in technology. The numbers are great there. There's a lot of beef. It's not like the dot-com era when companies were spending lots of money and making, huge losses. It's just a very different environment.
Got it. Okay. We received a comment here that global stocks have a strong correlation with U.S. stock market and can't really be used as a hedge. Is that something that you agree with?
I don't know that I would use that hedge is the right word for global stocks, but I think that there are opportunities in the global market. We think Asia is particularly strong, and from our perspective, I think it makes sense for core portfolios to have exposure to the U.S. and global markets.
Another question regarding horizon time. What is the standard time horizon for someone that invests, and what should the hold period be? Its standard hold period be?
I think it varies, from the investor. We're buy and hold we're basically a mutual fund and a wrapper, and we have a lower turnover than your average mutual fund.
Okay.
Our turnover is about 60% a year.
Fair enough. I think that I'm going through just about all of our questions here. I think that covers it. And just a close. Go ahead, Janet.
I'd like to say, once you own a high quality company, sort of an all-weather high quality company, you generally don't need to trade in and out of them. They tend to outperform over a longer time horizon. And also, can I say, if people want more information, they can call Alan or Darren, and they can also go to our website and sign up to be on our mailing list.
Perfect. Perfect. For those of you that are asking for contact information, it's there up on the screen now. Also, trimtabsfunds.com. You can get the portfolio breakdown that Janet had mentioned earlier. And then we'll also include this contact information as part of the follow-up email that everyone gets after this. So, Janet, thank you very much. Exactly what we were hoping for. Great questions from our audience here. We've got everyone staying right through the end as we clear the 5 o'clock hour there on the East Coast. We've got folks also from around the world. So for those of you that are joining us in Europe, we've got a few folks in Asia. Thank you for staying up and joining us this afternoon here in the U.S.
If anyone wants a copy of the presentation, they can email us and we'll send them a copy.
Perfect. Perfect.
Thank you so much, Jason. I appreciate the opportunity.
Thank you. Thank you for presenting exactly what we were looking for. And we look forward to sending the presentation out to those of you that are looking for it out there. And I think we'll go ahead and call it good there. So, Janet, have a great rest of the day. And for our audience, thank you for joining. Have a good day and good evening wherever you are. And we'll close it out there. Thanks again, Janet.
Thanks, Jason. I appreciate it.
Of course. Thank you. Bye-bye.
Good job.